So I'm most excited about this topic. This is my arena, primary arena, with capital markets and investing in the space. And I've known Gabe here for probably 12 years or so. We actually met through the CEO of a small publicly traded company called Medallion Resources, where they were back in as early as before 2010, looking to build a processing facility for mineral sands, which has a lot of specks of rare earth minerals, and it was a very difficult process to get that funded, sort of a chicken and egg deal. But the CEO was a great guy and introduced me to Gabe, and I met Tom more recently. But these guys, so I'll let them share more about their firm and what they do, but Amvest Capital is, and Gabe's a co-founder, is one of the unique banks and or financial services capital markets firms that exists in America, because they do what I do, which is fund a lot of the smaller companies that are public, some private. They're also global, and give awareness to these companies, services to get the word out on them. And that's very important, because it just doesn't exist with the size of deals that now need to come to market for real investment banks that are of size and scope to fund these companies. A lot of what we do is a bit lower, but they also fairly recently have launched the Terradon Fund, which is specifically focused on critical minerals and rare earths. But why don't I let you guys introduce yourselves and give a little background, Gabe, first on yourself and what you do.
Sure. Yeah, thanks, Eric, and thanks, everybody, for the time today. So I'm Gabriel Alonso-Mendoza. I'm co-founder and managing partner of Amvest Capital. We're an investment banking and an asset management business, so financial services, focus exclusively on mining and the full value chain upstream down to the downstream of the mining sector, the minerals sector, and have always sort of been tilting towards the U.S. And critical minerals and security of supply. And so, you know, we started this firm in 2017 when it was sort of still not mainstream. And you know, sometimes it doesn't pay to be early necessarily, but you know, we think we've you know, are well entrenched in this niche, and yeah, looking forward to being able to further develop these businesses and these a lot of these young companies that you know, the state of the market today is that a lot of these, as you've heard, a lot of these technologies are sort of just nascent, and gestation periods are very long for the mining side and also for the processing and the technology development side. So you know, a lot of what we do is support these businesses when they're small, and find that capital, invest that capital, and yeah, and so I'll just turn that over to Tomasz, who is the PM of our fund.
That means portfolio manager, for those of you that don't know. And I will say, Tom, you're a published author now. Definitely plug your great book, Mineral War, which you were very timely on. Available on Amazon. But go ahead, Tom.
Thank you, Eric. Mineral War is a book about how we got here, how come China managed to monopolize this space and weaponize it, and what we can do about it. So recommend it. The reason I wrote it was to raise the profile of the fund that we run, Amvest Terradon, which is part of that asset management, part of the broader Amvest Capital group that Gabe managed. My background's in mining. I learned it in South Africa, working there for many years, and then been managing hedge funds and family offices for mining equity, which is exactly what Amvest Terradon does. However, one difference. We focus on critical minerals only, the smaller markets, battery materials, rare earths, and specialty metals, metalloids for both civilian and military applications. And we're doing it exclusively outside of the Chinese value chain. All right, so that's a differentiating element of our strategy. I came to seeing this as an opportunity when the family office, which I managed, decided to pull the plug during COVID, and just thinking what I should do next. one thing I was doing, just reading Chinese propaganda. And I found in October of 2020 export control law. And sort of the bulb went off, and I said, okay, well, I'd seen it 10 years before, the first conflict over rare earths between Japan and China. So I saw the writing on the wall, looking for partners, and I found partners at Amvest. And since 22, 23, we've been running it quite successfully, proving that it is possible in an industry that was so focused on its legacy customer, China, to make money banking on scarcity value in these materials and lack of availability in this deepening process of weaponization. That since that export control law in 2020, by our count, there were 24 different restrictions regarding the flow of these materials, related technology, equipment, reagents, extraction technology, even in the case of DLE, not just refining and processing. So it's a work in progress, but it's possible to actually turn it into profit.
Great. And I know somebody from the last panel I moderated had mentioned, this isn't all doom and gloom. And I, by no means am I a doom and gloomer if I talk about the cutting through the hard facts of where we are today. It actually equates to me as just opportunity. I'm very optimistic, and there's a ton of opportunity for those of us that can deploy capital into this space and are familiar with it. So, Gabe, why don't you talk a little bit about your strategy? I will say that I invested in the Terradon Fund about a year ago, April, I think, and I don't check my statements very often, but when I did, about 12 or 13 months out, it was up 248%. So they take risk, obviously, with those type of returns. You have a correlated level of risk because some of these are smaller companies, some of them are fairly illiquid, some are private, but they have a real global viewpoint. So I don't know if you want to get into the details of the fund in terms of how many different stock exchanges and geographies that you're actually invested in, but maybe a little bit more so around where you see the biggest plays, and even if you want to get into any specific critical minerals.
Yeah, Tomasz, you want to take that?
Yeah, I take it with a piece of news from this morning. So amid all this doom and gloom, we shouldn't despair, really. Why is that? About 2 months ago, I visited one of the two functioning rare earth separation plants that function outside of a Chinese value chain. One is in Estonia, the other one is in Malaysia. I visited the one in Malaysia. And there, for the first time, I could touch the little containers with dysprosium oxide, terbium oxide, and a samarium oxide separated for the Western value chain. Western, I use the term here in the book as well in institutional, in its institutional significance, right? So Western means also Japan, Taiwan, and South Korea for us. And so this morning we learned that Lynas, that company that I visited, during the last reporting quarter, churned out about 19 tons of dysprosium and terbium, absolutely vital for doping of high performance, high coercivity sintered magnets that we need. Of course, they're gonna sell it to Shin-Etsu or someone in Japan, but then it's gonna end up with Lockheed Martin or someone else here. It's extremely encouraging. It's already happening. So what we're trying to do in our fund is to find some of those lower hanging fruits, because we think that the timeline is limited, and that unfortunately, the calendar, who's in charge of a calendar? Mr. Xi Jinping is in charge of a calendar. So we cannot really afford looking at things that have 15 or 20 years timeline. And by the way, with these interest rates, the long duration portfolio would underperform. We're looking for those 2, 3, 4, 5 different opportunities per each of those critical minerals, of which there are probably 30-ish, that will be the first, second, and third across the timeline. And we'll solve this problem. We'll solve this problem. But what's necessary is to reduce the cost of capital. Why is that? Because Lynas stock was actually down on the news. Why was Lynas stock down on the news? Because at the same time, it had to update the capex on its HRE plants, these heavy rare earth plants that will produce in large quantities dysprosium, samarium, terbium, and later gadolinium, without which we're not going to rebuild those missiles that we're just wasting in the Middle East. And so why is the market reacting like this? Because this capex is up 1/3. Why is the capex up 1/3? Because China controls the equipment and will not sell any equipment to the company that's solving the problem for the West. And therefore, the equipment will have to come from Canada or Finland or Sweden or somewhere else. at about a third of the price. So what we need to do in the market and the regulators is to do our utmost to reduce the cost of capital of our companies. Linus will deal with this. They sit on 1.2 billion Australian dollar worth of cash, so they can actually handle and pull it off. But the smaller companies, the pre-cash companies, cannot. And it's absolutely vital that we do our utmost to reduce the cost of equity of those companies earlier in the game.
Any particular critical minerals that you're most concerned about in terms of restraints over, call it, the next 1 to 5 years that could give us hiccups from national security and or energy, and perhaps which dynamics of certain critical minerals look the best to you in terms of opportunity and upside?
It's almost would be the same. If I could get hold of separated gadolinium, I'll buy it right now. So gadolinium, vital for electromagnetic warfare, a little longer wavelength than your sort of infrared detectors. Nobody currently separates this in the West on a commercial basis. There are some companies that can sell some dirty concentrate to Japan, and maybe someone in garage manages to do it on a small scale over there. But that would be my number one concern. Of course, gallium and still dysprosium and samarium. Tungsten is an issue. For those who haven't paid attention, China has cut off tungsten supplies to Japan for production of tungsten hexafluoride, a gas that goes into etching and doping in semiconductors for through silicon vias, which are those important connections deeper in your logic and especially in the memory chips. And so, yes, our industries are welded in the middle of the value chain to a lot of products that depend on these things with China. And so there are a number of those. You have to pay attention to substitution risk and substitution opportunity as well. That makes part of that criticality of these materials.
Tom, maybe you can answer this, but Gabe, I was just going to ask you about any portfolio holdings that you have that could be good substitutions that are sort of groundbreaking. That's up to you, Tom. But Gabe, first, why don't you, if you want to address that, great. But why don't you just talk about the landscape of what you see from your perch in New York around this entire issue and sector?
Yeah, it's a good question. I see a lot of waste. I also, by that I mean I see a lot of capital being allocated to projects that we necessarily wouldn't consider to be economic or ones that would be viable or ever turn on and be significant to supply where we need it. And there's probably some reasons for that, which I won't go into of our views, but I do see a lot of waste. At the same time, I do see the alignment in the U.S. capital markets with strategic initiatives, specifically meant, as it relates to new listings on our NASDAQ market or our NYSE market, and the indefinite timelines provided by regulators to companies trying to list around the review of their shareholder makeup, and that's to inhibit any bad actors or people that we don't want involved in our capital markets, as that's sort of a relatively new initiative by the exchanges. So I like to see that. And I also like to see the depth of the U.S. capital markets, accepting this industry. And just like anything else, there was going to be some sloshing around of money where it shouldn't be going necessarily. But that's something that we're talking to with foreign listed entities, foreign listed issuers that have real assets and have shareholders that are aligned with our Western objectives, to bring them into a deeper capital market where they could attract more capital easier without the restrictions of some of the other markets, and really at the end of the day, the capital problem is a real problem. That was the one thing that China was able to solve through a communist regime, being able to provide unlimited sources of capital at relatively no cost to develop industry that would otherwise not be profitable. And of course, that's sort of juxtaposed with our free market economy here. But as it relates to this sector, it's a strategic sector at this point. So we are starting to see some capital come into independent funds as well through OSC mandates. We're hopefully be the beneficiary of something like that when it comes through. That's sort of recent, but yeah, that's sort of what I'm seeing in the market today, I think we're just getting started here in terms of the development of these companies. There's been lots of capital raised, but not necessarily put to work, So yeah, I think we'll have to wait a little bit of time to see that take shape and really translate into a tangible result for our industries.
Great. And Tom, maybe go back to that other question, which was which minerals you're most concerned about us having some issues with, and also any portfolio holdings that are doing something in the substitution area that are encouraging?
Okay, so I wouldn't speak specifically to positions in the fund that regulators would not like me to do this in public. The idea. So we have three separate baskets. There is the battery materials basket that's sort of self-explanatory. There's the rare earth basket, and there's those smaller metals. Now, a lot of smaller metals are not available as mined commodities. Okay, you can go and find a tungsten mine, an antimony, or sometimes antimony gold mine. You can find, of course, rare earth mines. You can find a niobium mine, importantly. Hopefully, we won't be as dependent on Brazil in, say, 5-10 years from now as we are now. But you cannot have a gallium mine, a germanium mine, a tellurium mine, a bismuth mine, and so on. Where does it come from? It comes from, of course, as a byproduct. And the problem with this, for us investors, is that the level of payability from smelters and refiners for these minor metals are next to nothing, or sometimes really nothing. So you get low payability for cobalt often when it's associated with certain major metals, but it's much worse for those minor metals. And that has to be solved because, for example, if we take gallium, why is China the producer of 99% gallium? Because all the bauxite goes to China. It gets refined alumina, refining byproduct, and nobody extracts any value from this until now. Say Australian material, right, goes to China. So this is slowly changing. For now, from the regulatory perspective, but we have to solve the problem of payability. And so how do we approach it, to answer your question from the investment perspective? Well, sometimes we move a little downstream. So we look at, for example, like what is really the product, gallium product, that really matters? Well, of course, gallium nitride, right? I mean, the THAAD systems wouldn't function without it, or the radars. Or gallium arsenide maybe for certain semiconductors, a little shorter wavelength in the infrared spectrum. And so who's producing it? So we have to find who's producing it. It's important to also do the tracing. We heard a lot about this, where this material is actually coming from originally for these components. But there is actually a way to extract value from the component making, so the compound making, sometimes alloy making, and so on. And in specific materials, it's necessary to do this because who's going to build a gallium mine? That's not going to happen, right? So it's it forces us to move further midstream. It's helpful when this is cash generating because, again, it reduces the duration of the portfolio, and that helps us with the performance.
Good deal. And I think one of the things that I had a real, epiphany about a long time ago, because my background is as a lot of technology, venture capital investing back in my 20s and 30s. And then segueing into the minerals and metals, I think one of the things that particularly American investors haven't put together yet is that metals and mining is it's technology, because we need it out of the ground to produce any of these new things. I mean, particular with energy. I know, Gabe, you're involved in a junior uranium company. Uranium's a material that I don't think it's come up here at this conference, but when we're looking at having compute and energy for data in this AI race. To me, uranium is going to be, it has to be a significant backbone for our energy needs. Can you speak to perhaps what you're involved in with actual projects that could produce in the United States?
Yeah, and I think the problem in uranium is similar to the problem that we have in rare earths. And if you want to look to China, they've accelerated substantially their nuclear production, nuclear power plant production, and I think that they've obviously been ahead of the curve on high tech applications, and so a little bit have to look back to them now to see what they're doing. But our cascade capacity, which is the ability to sort of produce the midstream of the uranium, is now increasing. It's based in Eunice, New Mexico for the most part. They're trying to build other capacity, but of course, energy is going to be a massive component of any new technologies that we're embarking on, of course, of these data centers and all the things that you read about. But we're going to need a mix of energy. It's just like it's not just going to be natural gas, but of course there will be other sources of energy and yeah, so uranium obviously is a critical material. It's actually seen as sort of class 1 critical, and so the U.S. is sort of, whether it's the Forest Service or other permitting, fast tracking, they are trying to move that uranium mining forward. But of course, it's not just going to be the mining; it's also going to have to be the nuclear the reactors. You've probably read about the small modular reactors and other technology that's been around for a while. Actually, it's in those that are been in submarines know that it operates there for a long time. So it's totally possible, and it's just about bringing that into the mainstream. That was a part of what we do too, and have been doing for a long time, is educating the general public, especially in the United States, about the mining space, about minerals in general, because for the most part, when we started Amvest in 2017, when I would talk about mining, it'd be about, they'd ask me about Bitcoin mining, or they'd ask me about why it's an ancient industry, it's old economy, but they didn't realize the criticality of it all at the time. I think that part of what we've been doing all these years is trying to educate people about the importance of it and why they need to allocate capital to it. In fact, in terms of total assets invested in the sector, it's still probably about 1% of total assets. So if you're looking to make investments in the minerals space, all the way from the mining to the downstream, I mean that's probably a great place to allocate capital, just because of the supply demand of it all, and obviously we're betting on that, but yeah, it's yeah. So I don't know if I answered your question, but yeah, uranium is obviously going to be a big component of what we're going to need here going forward, and it's just as critical to enable extraction of all the other critical minerals.
Let me just add something to it. So Terradon Fund doesn't focus on uranium or indeed copper or any of the major materials. There are other investment opportunities there with Sprout or whoever. There's no doubt, however, that this is a vital element of a long-term solution for energy. My view until recently was that conversion, especially enrichment or lack of capacity, is the main problem here, although people who are closer to the market are beginning to be concerned about the feedstock. Maybe they are not sufficiently optimistic about the Athabascan. Who knows? Maybe legacy assets in Athabascan are going to run not for as long as we would think otherwise. So there will be a need for the feedstock. On the fund side, since we're not invested directly in uranium, unless there is a company that makes uranium and rare earths, and some of you may know which one I'm referring to, we do, however, pay attention to other elements of the nuclear cycle and the infrastructure itself: hafnium, zirconium, fluoride. And then you have to look at it from the perspective of the entire value chain. Is there a need for a fluorspar mine? Why? Because there's going to be 6 deconversion plants in the United States with a significant fluoride byproduct. And so you have to constantly balance the opportunity against the risk, including the risk of maybe the feedstock coming from another source, not necessarily primary source. And therefore, we have to pay attention to the uranium market development more broadly.
So let's talk about valuations. You guys, obviously, the last year and a half, knocked it out of the park with performance. And I know that you also believe that perhaps the REMX ETF is not necessarily a great benchmark because of your specialization and ability to go smaller. I mean, from my perspective, you've got enormous disconnects in valuations and market capitalizations of companies that have been around or have acquired and done some work on projects and deposits around the world, even particularly in North America, and they're trading for like $5 million market caps, $10 million market caps. These are usually Canadian listed companies that have an over-the-counter component, but you guys also go broadly. So you invest in all around the world, as well as via different exchanges, because the U.S., we have a huge opportunity, I think, for providing liquidity in a big way. Like I'm thinking when you're talking about small modular reactors and Sam Altman backing Oklo, which came public via a SPAC, which was destroyed. And then I ended up taking a position a couple of years ago. I think the stock went from like $7 to 170 or something in a fairly short period of time, which is extremely far out in terms of when that's going to actually happen, when they're going to produce anything. But it shows the appetite in the U.S. and the capital markets here have such power. But some of these deals are just too small. So that's a unique opportunity. But based on the fact that you've had such a lift in the portfolio, in say, call it the last 12 to 15 months, are there still bargains out there? What do you see, Tom?
Yeah. So I think there are screaming bargains. Had you asked me this question on, say, May the 5th, I wouldn't be so certain. But we've had just about 2 months of significant slide in this market and broader metal markets as well, especially on the equity side. Why am I saying especially on the equity side? We are here in the context of several metal markets that are not very liquid. And there is a bifurcation of prices between the oversupplied Chinese market, which provides us with the prices usually, and whatever we know about the non-Chinese prices from Rotterdam and some other sources. And they have not budged from their record levels, whether it's tungsten or yttrium or some other heavy rare earths and so on. Whereas the companies in general are down quite significantly. I mentioned REMX. So REMX is an ETF that's based on MVIS Rare Earth Strategic Metals Index. That's down about a third since mid-May. Now, careful, that particular index, an ETF, also includes Chinese companies and companies that do business with China. We don't do this. Interestingly enough, there is now a new product called REXC, which is critical minerals outside of China. But that ETF has been actually underperforming REMX too. So we've done much better than that, because in this kind of market, with this sort of nervousness, when you have the underlying metal doing very well and the equity market sliding, you have to make sure that you generate alpha while sacrificing a lot of beta. So having your volatility much lower than the actual market. That's what you have to do structuring your portfolio. And we've been quite successful in this in the last 2 months. However, I would say, regardless where the broader market goes right now, after a third of a slide, when the underlying metals have not budged, you see a lot of bargains around there.
Gabe, any comments on what you're seeing?
The valuation discrepancies are, I think, fairly easy to understand because it's based off of access points. And a security that is listed on the NASDAQ or the NYSE has a tremendous number more access points. For example, you can buy it in your Schwab account or your 401k or your retirement account or ETFs that are formed, passive index funds. if you look at a Toronto listed security, it's got significantly less access points. The same goes for Australian listed securities or London listed securities, et cetera. And the capital markets here are significantly deeper and larger than in those other markets, although legacy assets and legacy companies that have traditionally developed the mining space, the mineral space, etc., have been traditionally listed on those foreign exchanges. I think that's part of the reason why, we haven't seen, and those foreign exchanges also allowed a lot of Chinese investment to come in over the years. Now that has been reversed in large part, but there has been delays that have been either deliberate or not in development of those assets. Of course, regulatory and social issues also play a big part. But in short, what I'm seeing is an opportunity to create tremendous amount of value by taking an asset from a foreign exchange that is, again, checks all the boxes, and moving it into the U.S. because of supply demand as a basic point. And we can maybe highlight something that we see that's, we've got a name like Almonte, which I'll mention we don't own today, but we did at one point, and that trades at a significant premium per MTU, so about $1,000 per metric ton of tungsten versus a significantly better asset in a foreign exchange that trades at a fraction of that amount. And so if that, we think there's fundamental value, and that's two different things, right? Fundamental value versus value that's discoverable. And the access points to capital today are what allows for discoverability of capital or discoverability of value. So just because you love something and it's super cheap and it's undervalued on every other metric, it doesn't mean it'll ever become fully valued or realize its value if it doesn't have the right mechanisms to do that. And really all it is stocks go up because people buy more of it, and stocks go down because they sell more of it, or they don't go up because there's not enough people buying it. So we've seen, I think, very encouraging that we've seen a lot of interest from the investment community across multi-strategy funds, so everything from like the biggest funds in the world that you hear about to the mom and pop investor taking positions in these companies that are listed here on the NASDAQ or the NYSE, irrespective of whether they deserve to be invested in or not, because they need to find a way to allocate, or they're trying to find a way to allocate. They're trying to do the right thing, I think, at the end of the day, but the product is not necessarily the right product, we would argue.
Let me just add one thing to this. It's all very true. We have to connect somehow the depth of the U.S. capital market with these orphaned sectors, with companies that are, according to the sizes of U.S. market, prematurely listed somewhere else in those countries that belong to our Defense Production Act Title III regulatory framework. So what they produce is our domestic source. However, we've seen an attrition in the investment base for those foreign markets, other Anglo-Saxon markets, between the great financial crisis, 2011, which was the entire mining market was overheated with massive inflation, and the boards took a view they have to focus just on value and predictable flows of several main commodities, and these markets are usually too small for the big companies. But what happened over the subsequent 10, 12 years was a total attrition of the specialist mining investment environment. In my book, I give two examples. One is in London market, which shrank in terms of the dedicated funds for mining from $40 billion to about 12 between 2011 and 2023, and the Canadian market around that time from $14 billion to $2.8 billion. Okay, you cannot rejuvenate the industry. And what happened during this time, 2011 to 2023? Well, the Chinese, of course, moved in with zero cost of capital to compete at scale. And so Gabe mentioned bringing companies to the US market. And I agree with this. It's either Muhammad coming to the mountain or the mountain has to go to Muhammad. We have to actually help our investors, you investors, to go to those markets, and maybe with some tweaks to the tax treaties, so that we can support those companies and reduce their cost of equity and cost of capital more broadly, so that they can compete against the Chinese companies across the entire development schedule.
Thanks. We don't have that much time, but I was going to say, I don't think you have to worry about the regulators for mentioning what you own. Just don't give any price targets. But, I think this point is huge, because there are people like us that are going to work on getting really good assets to real capital markets, meaning it's all about liquidity, I think, at the end of the day, and access, where I can go on my Robinhood app and, buy an overpriced story versus, at the Gold Investment Letter, I actually have I call it the venture cap portfolio, where I look for usually TSXV or Canadian Stock Exchange. They do have U.S. foreign listings, but they don't, primarily they're not located in the U.S. If you go back to, I believe the stats are 1980, the Canadian capital markets funded, it was close to 80% of mining projects. That has shrunk down to, it's in the 40s now. But that is it's been a very prolific market for these ideas, the ASX as well, which I'm not as involved in. But the fact is that there are orphan deals. I look at, something that just popped into mind with the very high price of the material of molybdenum. I cover a very small company called Aranova now that has with molybdenum in situ value in Canada with their deposit of excess of $20 billion. Doesn't mean that's ever going to come into production or anything else, but I don't see a reason why that couldn't be, stories like that can't be uplisted into very liquid vehicles, because they're just, nobody knows about them, they're not getting access. But so it's huge what you guys do and where you get involved, because there's not a lot of us that go into this area, but it is going to, I believe, grow as awareness comes in with this space. People will get more comfortable. But we're going to go to Q&A in a second. Any comments, Tom, that are really important to you from the book you might want to highlight?
There are so many that I encourage you to buy the book. But one more word about just what you said. We're doing a lot of right things right now. There's a lot of movement. There's a lot of momentum in the government. There's a lot of bilateral deals that have been signed. Certain elements of these deals raise a question whether we all understand the structure of this industry properly. Let's take the Australian deal, like US-Australia deal. I happen to be in Johannesburg. I see something on the screen. Turns out that Kevin Rudd doesn't like our president. But that's not the news. The news is that we opened our capital market more broadly for the Australian Superannuation Fund. All right, so what happens if Australian Superannuation Fund can invest at larger scale in the US? They're gonna orphan local mining companies. We don't need Australian capital here, honestly. We need our capital to support those companies among our allies. And so the direction of travel is not always ideal for the redevelopment of the mining and metals industry. We have to factor in the existing structure. We have to start where we are. And so the book is about this, how we got where we got here. And I don't think we can solve it unless we understand what happened.
Thank you. We only have about 5 minutes left. How about some questions? Let's see. You guys can hustle up to the line there so we can get a few in at least. Welcome back, sir.
Hi, Volodymyr Berezhny, K66. So, first, Tom, I enjoyed the book. I recommend everyone to read it. Mineral Wars, amazing book, a lot of insights. So, everyone should take a look at that. Full disclosure, I know both of you. I haven't invested with either of you yet, and neither of you invested into K66, so I guess we are even. Here's a question. Imagine you have a 100 million project with a lead investor, 2 family offices, and 2 strategic offtake partners, 1 US and 1 Japanese, who do not want to be in the same venture together, Japanese and US, because they are offtake. Would you choose one strategic partner, keep the other one as offtake only customer, or create a parallel SPV under a common holding company? Which structure best preserves access to both markets? Thank you.
I don't want to upset him, so it's up to you.
I think it depends on the scale of the operation and what the amount that you'll be producing. So to the extent that there is enough scale, then it'd be beneficial to separate between the two. The other consideration would be investors and alignment. Which one of those two parties are you going to be more aligned with? Is the business going to be more aligned with? Is your investor base and your stakeholders going to be more aligned with? And that's the one that you choose.
Tom, you can upset him. Go ahead.
So usually there are about 2 glass walls between me and Gabe because of regulation, but on this one we agree.
Good deal. Next question.
Great, thank you. Julia Kennedy from the Weiss Consulting Group. I have a question about sort of the broader finance ecosystem for critical minerals, both on the supply and demand side. An earlier panelist mentioned the need for low-cost debt. And I'm just curious what you guys are seeing in terms of sort of the larger financial actors moving in the space, whether it's institutional investors or commercial banks, how much they are responding. Another panelist on kind of the demand side talked about their traceability system and some of the issues with bankability and compliance. And I'm curious what your companies are facing in terms of some of those either ESG risk issues or other compliance issues, both domestic and internationally. Thank you.
Thank you. So I'll start with the last thing, ESG, hugely important. I'm coming from mining industry. I know something that's just not done properly is not going to be sustainable. So we pay a lot of attention to it. But we are an equity fund. So we're not lending money, at least on my side of the business. We don't lend money to anybody. I think the issue of credit guarantees, government credit guarantees is probably the right way to go to reduce that cost of debt and that level of risk perception. We're never going to be exactly at the Chinese level. Those banks don't need risk management. This is just deployment of capital, hence the misallocation of capital, and hence 360% debt to GDP in that economy. Let's not forget it when we are just so wowed by the productive forces, as Marxists call it. Okay, it has a certain cost. But the question remains for us more on the equity side. What can be done? And I think here the IR codes are the solution.
I'll just mention that I think we're very spoiled in this room because a lot of us are well aware of the industry and the situation. But in terms of the larger banks or the larger institutional investors, I think it's underestimated the lack of understanding and the capacity to actually deploy capital in a way that is constructive. And in fact, if you look at, we'll just remain nameless, but if you look at some of the larger institutions that have deployed capital, I know by speaking to them that they are internally lost. And in fact, they leverage other entities, whether that's major mining companies, to do their due diligence. And all they're doing is following. So there is no leadership. I think that's what we're trying to establish. And I think that's also leading to this lack of speed.
One more question.
Well, I'm going to speak to the due diligence. I worked on a group of people from 1997 to 2017, and we wrote all the understanding of the 43101, the SEC code, the JORC code, the New Zealand code, and 26 other countries. Now, I read one of the rare earth reports. They did a terrible job of writing it. So you investors can't tell what's going on. I've got the other 5 coming in for the other 5 rare earth companies. I hope they do better. But if you follow the due diligence in those codes, you should understand what's going on with a company. But there's a lot of things missing. This quality of the equipment, a 10 or 15-year statement of where they stand. Companies are terrible. I'm used to having 40 years of reserves. Some of these companies, 3 or 4 is fine, and some they don't even mention it. So just a question, do you use the JORC reports, the 43101 reports, to make any of your decisions?
Of course we do. We cannot function otherwise. So
I pity you. They need to know how to write them.
Yeah, it's easy to refer to some of the U.S. companies that don't do this yet. I think the way we see it, that most likely, given the currency that they're receiving from the government, they might be in a position to accumulate assets elsewhere and purchase some of the companies that actually do comply with JORC and 43101, and by osmosis, they'll learn this way through consolidation.
We're out of time. Let's hear it for our panel.